Bloomberg Tech is live from the heart of Silicon Valley with Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, another mega bond sale. Alphabet looking to raise as much as $25 billion from its latest offering. A deal that will test investor appetite for AI-related debt. Plus a rough day for Western Digital, or WD. The storage giant slides after a disappointing outlook despite the broader AI infrastructure boom. And Sequoia's leaders, Alfred and Pat Grady, join us on the future of the storied venture capital firm. It is a debt day. That's what we're talking about. Today's big number, $89.5 billion. That's how much Alphabet debt has been sold globally since 2025. Looking at shares of Alphabet, the Google parent, in the equity market, the stock is flat, but had been under some pressure in the last 24 hours about a wave of departures. We'll bring you that story later on. I want to zero in on AI debt and get more on Alphabet with Robert Schiffman, Bloomberg Intelligence senior credit analyst. This is a $25 billion denominated offering, 10 parts, right? But it's the latest in a sequence of bond market activity. You write, borrowing fears, question mark. Answer your question mark.
Yeah, the answer right now is no. I think the second quarter prints that we saw for the biggest hyperscalers actually prove to people that all the money that they're spending is being monetized and the confidence levels have improved. You're seeing that with share prices and you're seeing that with bond prices. The demand for this deal, I think, is going to be substantial. What we heard already was that the books were at $65 billion. I think they're only going to issue $25 billion. So not raising it is positive. Obviously, their cost of capital is going up a little bit. But after increasing their CapEx guidance by $20 billion just a week or so ago, this shouldn't be a surprise to anybody. And quite frankly, I think they're actually front-running a lot of next year's borrowing. And this might actually help technicals going into 2027 versus hurt them.
On a US dollar basis, Alphabet, it's at $42.5 billion since 25. Amazon's $77 billion. You have done a really good job, Schiff, of explaining to the Bloomberg Tech audience why it's different in the here and now to say the dot-com bubble, the financial crisis. Like, what do the balance sheets of these companies and their top-line growth outlooks differ from that period in history?
Well, these are real businesses that are generating cash, that are just spending more money these days to make more cash down the line. We're starting out with a tremendous amount of balance sheet flexibility. Alphabet traded AA plus at S&P. They're one notch away from the highest potential rating that you can have. And the rater said this morning they have $200 billion of net debt capacity within their current ratings. That means just to fall a notch to mid AA, they would have to issue another $200 billion of debt and spend it. So I think the flexibility that you see from, we've said it time and time again, these Mount Rushmore of credits, enables them to borrow as much as they want. And the concerns that people have been having that they're not going to be able to fund themselves as CapEx budgets go up by 50 or 100% next year, it's just not true. They can borrow, they can raise the money, the demand is there, the balance sheet flexibility is there, and people are now getting paid for it versus 2 or 3 years ago when you got basically no spread to own any of these names.
Robert Schiffman, Bloomberg Intelligence senior credit analyst, thank you very much. I mentioned the news story for Google, which is Google is undergoing its biggest AI leadership shakeup in years. Longtime AI executive Jeff Dean is leaving to launch a startup with several senior DeepMind researchers, while DeepMind CEO Demis Hassabis is stepping back from day-to-day operations to become chairman of DeepMind, but also Alphabet's chief scientist. The changes come as Google faces mounting pressure to keep pace in the AI race, with investors basically questioning whether the company can retain top talent and turn its AI research into commercial success. That was the stock story of yesterday. Let's stick with Alphabet. Joining us is Natalie Gallagher, principal economist and director at Board. I want to go very briefly back to Alphabet, going back to the bond market. What does that signal about where we are in a CapEx cycle?
It really signals that we're continuing to mature in the CapEx cycle. We have had the hyperscalers, largely following a similar playbook. That's to utilize internal cash flows, keep leverage low, right? When you do look at the balance sheets more holistically, solvency really isn't an issue. And so I really see no cause for concern. When we talk about Alphabet specifically, they just had their first quarter of negative cash flow since they went to IPO in 2004. So I'm not surprised to see it.
The Economist's view of seeing companies of Alphabet scale, and they're not unique in that respect, entering negative free cash flow, does that go into the economic model?
It speaks more holistically to the commitment of spending by these hyperscalers on AI, right? And they're absolutely spending with the belief that future cash flows are really going to validate that level of spending. Now, we've talked about this before, but really the question becomes not, can they continue to do so? It's very likely, they're in very strong positions balance sheet wise. The real conversation is around the risk and what capital misallocation looks like if the bet doesn't pay off.
I want to go back a little bit to Federal Reserve Chair Warsh's first meeting and press conference, because he discussed CapEx, the CapEx boom, and I'm paraphrasing, but what he said is that CapEx boom is driving up prices of AI infrastructure, right? That was his analysis. Is there an inflationary impact elsewhere in the economy from what's happening in AI?
There is a broader conversation happening right now. How much of the economic growth we are experiencing is it because of AI? And there's really, multiple areas in the economy that this can come out. One is CapEx by these companies directly. The other is actually in asset price valuations, right? So think of all of the gains that have really happened in the stock market right now. There's a very strong argument that that is in fact inflationary, because when people have more money, what do? They spend more money. Longer term, and Warsh has come out and said this sort of historically, there's a belief system that because AI increases productivity, it's actually disinflationary in the long term, which is why as a Federal Reserve chairman, he's very, or has shared comfort with having a lower neutral rate in the future.
Every day we're still trying to understand the impact of AI on the real economy. Like if you look at labor productivity, where it runs now relative to pre-pandemic, is there any tangible evidence in front of you that AI is in some way impacting that data?
Yeah, it's a great question because, when we talk about the overall implication of AI and making it all worth it, right, we have to talk about productivity. When we look at a pre-pandemic sort of productivity growth rate, average growth rate, we were at about 1.5%. Post-pandemic, we've been closer to 2.5 to 2.75% on like an annualized basis. Now on the front, that looks really great, right? You get a lot of people that are saying, hey, that's happening contemporaneously with AI, story done, right? We have the AI productivity story. But what we actually can do is a lot better, right? We can look deeper and look at metrics like total factor productivity, utilization adjusted. And that helps us really tease out, okay, out of productivity growth, how much of this is really coming from innovation? And that on a 4-quarter basis is trailing at about 0.7%. So that's essentially flat. Quarter 1, 2026, the data is a bit delayed. Quarter 1, 2026 actually came in negative 2.76%. Now, there's contemporaneous impacts with the Strait of Hormuz closure, so we can't perfectly extrapolate. But I share all of this to really say that at this point in time, we don't have the macro evidence that AI is meaningfully impacting productivity.
I appreciate that because I feel like it connects the dots from the data points that a lot of the software companies gave in earnings on how AI is actually being used. Natalie Gallagher aboard, thank you very much indeed. Another big story, take a look at shares of SpaceX, which are behaving interestingly. They're up 3% in the session. There was a heavy decline yesterday. Reminder that there is a lockup expiration on around 900 million shares, which was a complicated structure for lockup post-IPO from mid-June. Right now, the stock's higher 3%. We'll continue to track it. Coming up, we are still in the thick of earnings, and this time, it's all about hardware. WD CEO Irving Tan joins us next. This is Bloomberg Tech. Let's take a look at some of the storage stocks. SanDisk, Seagate, Western Digital. Differing performance. SanDisk to the downside, Seagate higher on earnings performance. Western Digital's down 9%. At one point in the session, had been down more than 20% and on track for its biggest drop since the year 2000. That has turned around somewhat. Let's stay with WD. WD CEO Irving Tan joins us now. We're getting back to the AI hard disk drive story. Irving, it's great to have you back on the show. Investors still believe in that story. AI, hard disk drive. Your stock is under some pressure. Just reflect on the moment that you tried to outline in this earnings print.
Yeah. Well, first of all, thank you very much for having me back. If you look at the results that we delivered in Q4 fiscal 26, they were very strong. We had over 40% revenue growth. Gross margin was above 54%. Very strong cash flow generation as well. If anything, probably the expectations were very high in terms of the increased amount of exabytes that we could supply into the market. But if you take a step back, really the fundamentals for ongoing revenue growth, margin expansion, cash flow generation remain very strong. On the demand side, demand from hyperscalers, neoclouds, physical AI remains very robust, and we continue to see over 25% CAGR demand from a demand perspective over the next 5 years.
Right.
Similarly, on the supply side, we have a very robust roadmap that we have put in place that will be able to meet this demand. And so it's pretty much a function of just quarterly transitions that we're going through.
Irving, what you're touching on there is, storage is distinct in many ways from what's happening in memory. In some ways, highly analogous, right? There is a pricing story there. There is a demand outpacing supply story. And your industry facing the balancing act of expanding output, manufacturing capacity on a permanent basis or not. How are you managing all of that?
Yeah, so first of all, thank you for highlighting that. There's a clear distinction between memory, which is like NAND and DRAM, versus storage, right? Because memory and compute is being recycled all the time for different workloads. But the data that's being generated continues to be stored. It isn't getting deleted. So the amount of data storage requirements is just compounding over time, which puts a lot of more demand on our products on an ongoing basis. And how we're trying to solve for that is really through technology. We're not investing in increasing the number of drive units we're producing. We continue to invest in technology to increase the amount of hits and media that we produce, because that's the big driver of capacity in a drive. So we're currently shipping a 32 terabyte hard drive as our top of the line drive. But starting this quarter, we'll be shipping a 40 terabyte drive. So that's an ability to drive over 30% capacity to customers without adding any unit capacity.
Could you go into how that works? Bring a 40 terabyte drive to market, the engineering complexity of it, and how much do the customers have to sort of re-architect their infrastructure to accommodate for that new generation of HDD?
Yep. Well, hard drives are actually, as an engineer, I always view hard drives as a marvel of engineering. We use 2/3 of the periodic table in our product. So as we move from capacity point to capacity point, there's a lot of re-engineering that goes on into the recipe of our media designs, the recipe of our hit design. So it's quite an engineering feat. Obviously, we have great teams that have years of experience doing that. At the same time, we work very closely with our customers to make sure we go through very robust qualification processes, because customers are very sensitive to the quality and reliability of their data storage capability.
The other sort of highly analogous factor that is in front of you is long-term agreements. With the memory market, we see long-term agreements coming in as well. So you have these in place like 2029, 2030, 2031. How do you know how to price an agreement today going that far into the future?
It's a really good question. We do have LTAs in place locked in till 29. We have customer demand. Customers are coming us to put LTAs in place to support demand for 29, 30, and 31. They have really good visibility in terms of the storage requirements that they need, because they're looking at the entire AI infrastructure stack, everything from GPUs to CPUs to HBMs to NAND to storage. And they realize they have to take a much longer term time horizon in terms of how they plan. So we are working very closely with them. We're definitely locking in the sort of exabyte supply that they need. But what we're working through with them is still the commercial construct of how we would price something further out in time.
Right. So let me look at it another way. Somebody comes to you and says, Irving, I'm a big customer and I want to lock you in until 2031. Why might you say no?
Well, what we are saying, Ed, is if you need 600 exabytes of storage in 2031, we will deliver that to you. How we actually price it, we're still in negotiations with them where we might have a base price for a percentage of that volume and then a tiered pricing structure as we increase the capacity we deliver to them.
I don't mean to trivialize this in any way, but it's the hard disk drive moment. Make hard disk drive great again. What's that been like for you to put the technology at the forefront of discussion at the moment?
Well, it's really exciting. I mean, people thought that hard drives were a thing of the past, but it's shown to be a fundamental piece of the AI infrastructure stack, with 80% of all storage in the cloud and AI continuing to reside on hard drives both today and going forward. So it's a very exciting time for us. It's a great challenge, and I always tell my teams it's a great responsibility that we have to deliver to the industry to enable this once-in-a-lifetime opportunity that AI is creating.
So Irving, I go back to the stock. Again, it's down about 8 or 9% right now. It was down 21%, its biggest drop on paper since December of 2000. A lot of the analysts are talking about your comparison against Seagate, what Seagate's doing on margin expansion, etc. How would you answer those analyst reports on how you are performing relative to your peer?
Yeah, as I mentioned in the beginning, there'll always be quarter-to-quarter variations. We were the first one out for 32 terabyte. We gained on them. They have a new platform coming out, so they're a bit ahead in terms of the exabyte storage that they can deliver that drives gross margin expansion. We have the 40 terabyte coming out in Q3 of our fiscal year, and we expect that by that period of time. Sorry, we have a 40 terabyte out right now. It's going to cross 50% of all the bits we ship by fiscal Q3, and that will give us another driver of exabyte growth. And so this constant evolution of technology and the transition points that we introduce them will result in some time shifts in terms of results and performance.
Right. WD CEO Irving Tan back on Bloomberg Tech. Thank you very much indeed. Okay, coming up, we're going to stay with earnings, and it's Figma. Figma CEO Dylan Field joins us. This is Bloomberg Tech.
It's time now for Talking Tech. I'm Yahira Anand. First up, DeepSeek says it plans a, quote, significant price hike for its AI products. While the changes weren't specified, the announcement is an unusual shift from the Chinese AI companies that have emphasized low-cost models. Plus, Meta's recently released Muse Spark 1.1 breached an outside firm's systems and accessed the internet during cybersecurity testing. This comes just days after similar incidents from models by OpenAI and Anthropic. And Figma CEO decided to forfeit $46 million in company stock awards in an effort to ease investor concerns over AI. Dylan Field made the forfeiture voluntarily and no replacement awards were issued. Looking forward to the interview, Ed.
Yeah, thank you, Yahira. Let's stick with Figma. It comes as the company reported its second quarter sales and profits that exceeded analyst expectations. Shares are on track for their biggest drop since September, down 17% or so. A lot of that is the guide for the third quarter, the current period. Figma CEO Dylan Field is with us. I think, beyond the numbers themselves, Dylan, some are looking at this and saying, well, there's lots of new Figma products. Is Dylan being conservative in guiding how those new products are showing up in the latter part of this year?
Well, first of all, good to see you again, and thanks for having me on. I think that as we look at forecasting in general, our guidance does not always price in potential upside of efforts that have not proven themselves yet.
Right.
And we try to make sure that we guide based on what we can observe. And what we did observe this quarter was very strong revenue growth. Year over year, our revenue grew by 48%. And this is our third consecutive quarter of accelerated growth. It's also our first full quarter of AI monetization. And our NDR was about 136%. So overall, we felt very strong. And we are very much investing for what's ahead.
How are the customers behaving? Like, what's the story in the fields that you sell your software into, Dylan?
Yeah, I would say that customers have been on definitely a journey as they look to figure out how do we integrate AI into the workflow. And some of those customers, that journey, they really understood where they were at and what they were doing, even end of last year. And we're doubling down on Figma then. Others, I think, those may be the early adopters. Others have been working through that process of figuring it out throughout the last 6 months. And they're also coming back to double down on Figma fully. And I think that as workflows change, what we're trying to do is meet customers where they are. So what we see are customers sometimes starting with design, sometimes starting in code. And with our MCP, they can pull their work into Figma, or they can read from Figma to go build. And more of that will be fully encompassed in the Figma workflow with our agent in the future.
Dylan, a lot of people today are reading the story. Figma CEO forfeits $46 million in stock after share decline. What was your thinking on that?
Well, I did it a while back, so it wasn't linked to yesterday. But yeah, I mean, look, dilution is something that I feel just like our shareholders feel. And given that this is an investment period right now, that felt like the thing that made sense to do. And yeah, I mean, mostly my entire head is in how do we invest for the future? Because we have so much we can grow right now.
You're still trying to build.
Yes.
We just have 30 seconds, Dylan, but what are you most focused on building right now?
I'm focused on a few things. First, our Figma agent, making it so you can, we already have this out, but getting that to monetization, and also making it so that we're able to serve customer needs and workflows better. I'm also focused on code layers, bringing code into the canvas and making it so that as code becomes more of a commodity, design is the operating level and layer that you're able to work in order to define what your team is doing and able to make it so that people build great software from there. And I think that if we can capture that and make it so the Figma agent can support these workflows, then you'll be able to build out from the design layer. And from there, I think there's so much that's possible, and you can really have designers steering.
Figma CEO Dylan Field, back on Bloomberg Tech. Appreciate your time. Thank you very much indeed. Coming up in the show, Sequoia partners Alfred Lin and Pat Grady, the firm's latest leaders, the new titles of co-stewards, join us. We're going to discuss what's changing at the firm, what the tech companies of tomorrow are, and what the future holds. This is Bloomberg Tech. Welcome back to Bloomberg Tech. Last November, longtime Sequoia partners Alfred Lin and Pat Grady became the firm's co-stewards. For more than 50 years, the Silicon Valley firm has backed some of the biggest winners in technology, from Apple and Google to Nvidia. Today, it manages more than $80 billion. But as detailed in Bloomberg Businessweek, it recently raised another $10 billion across its growth and expansion funds. Since then, the Sequoia partners have made a risk-the-franchise investment in Anthropic. They've returned to investing in chips and continue to hold onto one of the firm's greatest investments, SpaceX. With us now on Bloomberg Tech, Alfred Lin and Pat Grady, to discuss what's changing at Sequoia, the technology companies of tomorrow. I want to start with our Sequoia. You published what reads to me as like a mission statement. It outlines principles the firm's held for quite a long time, and I think some new ones that you are trying to emphasize. Alfred, is that fair?
Well, first of all, thank you for having us. It's really fun to be here with my co-steward, and we get to do this together. And it's because it's our Sequoia. It's not, It was never Don's Sequoia when he named it Sequoia Capital, and it wasn't
54 years ago.
54 years ago. And so Pat and I wanted to make sure that everybody at Sequoia thought of it as our Sequoia. That's principle number one. Principle number two, if you take care of the founders, they'll do right by our LPs. We do right by LPs. We'll do right by Sequoia. We do right by Sequoia. We can take care of the team, and then we can take care of every single person at Sequoia.
Right.
That is principle. That is a principle that has been at Sequoia for a long, long period of time. And also, we are only as good as our next investment. And that is not a risk your franchise. It is what makes us Sequoia into the future.
I noticed the smile when I read out the line. We'll get into how that manifests. I mean, it's a co-steward title. You regard yourselves as partners.
Yes.
As part of a partnership.
Yes.
You are not managing partners.
Correct.
You, as Sean Maguire outlined to me in a telephone call, he rejects the notion that you're bosses. You are partners in a partnership. But to lots of people, they're like, how would that work, Pat?
Well, so first off, on this boss thing, we had a funny conversation with one of our partners a couple of years ago where he referred to somebody as his supervisor. We're like, your supervisor? What are you talking about? He's like, well, he's my boss. He's my supervisor. We're like, no. This is a partnership. The only way that we're going to bring out the best in all of our partners is if it feels like a real partnership.
Okay.
So one of those principles that you mentioned with our Sequoia is this idea that influence should be awarded to expertise and reason and not to tenure and hierarchy. And what that means practically is, in any given conversation, if we're going to make an investment decision, Alfred and I might have less of a say than our other partners, like Sean or Andrew or Sonia or David or Konstantin, because they might actually have more expertise on a particular topic than I do. In fact, they have more expertise on most topics than we do. And so this idea that influence should go to the people with the expertise, not the people who happen to have been around for a long time, that's what makes it a partnership, and that's what allows us to play at our best.
There's no tiebreaker, essentially, that you two get awarded. You participate under the same rules as the rest of the partnership.
Correct.
I mean this with full respect. What does the term co-steward communicate that any other title doesn't? Why? I think you both don't want to get bogged down in administrative duties. You want to participate in the partnership.
That's part of the reason why we get to do this together. And part of that is we are partners across the board, and we get to help lead the organization. In part of leading the organization has to do with making sure that we have structure and we sign SEC documents. A lot of it is administrative, and we get to split that so that both of us can stay on the field.
I try to make sure that Alfred signs all the SEC documents.
But literally, this is the part that is really good about this. This is a partnership. We want to show the value of partnership, and we want it to be a team effort, and not everybody has to do everything.
And this idea of stewardship, if you go back to the original generational transition, which was when Don Valentine handed the firm off to Doug Leone and Michael Moritz in the late 90s, the standard at the time was to have the younger partners buy out the departing generation.
Right.
Don instead gave it to them for free and said, your only job is to leave it better than you got it. And so that's become a very core part of the Sequoia culture.
You continue that tradition.
Yes,
Absolutely.
this idea that we're stewarding it for the next generation, as opposed to, there's no concept of ownership at Sequoia. All of the partners own the partnership together. Our job is to make it great.
We're sitting here talking, but you're 8 months in, essentially, as co-stewards, but in that time quite a lot of things have happened. I want to get to what you've enacted or changed that's different in that 8-month period to the history of the firm. And one of the things outlined in the Business Week article is, if you are a partner that is interested in an investment, you can propose at any time.
Yeah.
Yes.
Through a various meeting mechanisms. So traditionally in Silicon Valley venture firms, you have your Monday morning meetings. You guys have said basically 7 days a week, any time. Let's talk about
being customer obsessed.
Yes.
We are
Who are your customers?
Exactly. It's founders. And so we should work on the founder's time frame. If the founder wants to make a fundraising, they have a timeline. We should abide by their timeline, not the other way around.
Right.
And this notion that we get to have every decision happen on a Monday is kind of a little backwards. Are we the customer to the founders, or the founders our customers? And for us, we want to make sure, and we want to send a clear message that the founders are our customers, and we're customer obsessed.
And there's a second concept here, which is outlier founders want to work with outlier people. And so our partner Ravi has this idea of playing free. Everybody should play free. And we don't want Luciano or Andrew or Konstantin or Sean or David or Sonia. We don't want them to become another Alfred or to become another Pat. We want them to be the best version of themselves. And the only way we can do that is if they feel like they can play free, like they have rope to just go at 100% velocity all the time. And then our job is to help enable them not to get in the way. And so we are tight on principles, and we are tight on values. We're very flexible on process.
So some people, that might sound chaotic. Literally, how does it work mechanically?
It is chaotic.
Somebody will send a WhatsApp to the rest of the partners saying, guys, got a great op. We have to meet now and talk about it. Then what happens?
A couple days ago, an email came out recommending an investment, controversial investment. We go into a document. There's a lot of commentary in the document. Here's what's good. Here's what's bad. Here's what I like. Here's what I don't like. What are we going to do? We had 6 people on red eyes to New York a couple nights ago. We went and spent a couple
week. This calendar week.
Tuesday night.
Came back.
Tuesday night, we had 6 people on red eyes to New York. Randomly, we were on 5 different planes. I don't know why we took 5 different planes to get to New York.
But it was a spur-of-the-moment decision.
It was a spur-of-the-moment thing. We spent 2 hours with the company yesterday morning. Yesterday afternoon, we signed a term sheet. So, gang tackle, get everybody in front of it.
I'm juicy bound to ask you which company.
Oh, I know. I'm sure you would, but yeah.
And the answer is, can't comment for now.
Company TV, probably a monster. Probably one that's going to be huge.
Was it a big check, as in the stakes were high?
Come on now.
No, hang on. Our job is to invest the smallest possible dollars for the largest possible ownership.
Our job is to put small dollars to work and make them large dollars.
There is some case studies we're going to get to later in this conversation that would say slightly otherwise. Let me ask you this. Ask you this.
We can do the big dollars if we have to.
Conviction over consensus. So in lots of partnerships, be they a venture firm or a law firm, you vote.
Yeah.
Your structure is very different. Things are not achieved by consensus. How does it work?
We vote, but the point about conviction is that you need conviction to be committed for a company for a long period of time. We love building companies and helping founders build companies. We want to be an early believer and compound with them into the future. And that requires real conviction by the person who has the most expertise. And so when we debate, we are trying to sort of get to truth. We are a truth-seeking organization. And there's much better conversation when there's a debate than when everybody is, oh, yeah, I agree. And then it's usually a meh investment.
And let me give you an example on that.
Please.
So 2019, Sean McGuire joins Sequoia Capital.
Yes.
He joins the early stage team, okay? 2019, Zoom had just gone public. We just gotten into business with Dylan Field at Figma, who I know you guys just had on. The combined market caps of Tesla and NVIDIA were approximately the same as the market cap of Salesforce. So to set the stage in 2019, the thing on the menu was software.
Yes.
Software was consensus. We love software. Everybody loves software. Sean, a brand new early stage investor, shows up and says, I think we should invest in a rocket company at $20 billion. We thought that was insane. But Sean had conviction. He had done the work. He painted the picture. This is pre-Starlink, right? This is when it was a launch company and the main customer was the government, right? Sean painted the picture of what this thing had a chance to become, and it's become one of the best investments
we're
we've ever
talking about
made.
SpaceX.
And so that was SpaceX, yeah. So that was conviction at work. That was 2019.
What I'm trying to get to is the idea that in any number of voting partners, the majority might say, I have a lower conviction, I have a 4. You guys do it on a scale of 0 to 10, you don't count 5. But just 2 might say, we are 8s or we are 9s.
We love those kinds of investments.
And you do go with the investments.
We've been recording the data since 2014, so we now have 12, 13 years of data on this. And we thought that contentious investments would actually be the best investments. And it turns out it actually doesn't matter whether it's contentious or consensus.
Yes.
All that matters is presence of conviction.
I want to get to Sean because it's outlined in the Business Week article. And Sean has been on this program, and I've spoken to him somewhat regularly, right? The idea is that Sean has made, let's call it, say, incendiary posts on social media. He has said things that are divisive, but you regard him as being unique, right? He has a unique background and set of interests that you believe put Sequoia into opportunities that you would not otherwise have. I don't want to speak on your behalf, but let's talk about that.
I think we should just talk about the balance sheet of Sean. Lots of
the balance sheet of Sean,
the positives and negatives.
I see.
You just talked about a bunch of negatives, and I just want to make sure that people understand the positives. The guy was one of the top 10 Counter-Strike gamers when he was in high school. He was a day trader in high school. He then went and got a PhD in physics, in quantum theory. If you sort of regard physics is hard, quantum theory is one of the hardest. When he joined Sequoia, he put together a hardware manifesto. He led us into hardware. He led us into SpaceX with a lot of conviction and a lot of courage because there was votes by GPs that was a 1. On a scale of 10, it was a 1. And he kept pushing and pushing and pushing.
Was he a 10 out of interest?
He was a 10 out of 10.
Okay.
Sean tends to be either a 0 or a 10.
Okay.
Fairly binary.
Very binary person. And so, in terms of conviction, he has strong conviction. He's been right a lot. He helped lead us into crypto. And I don't want to talk just about the negatives because I think people need to understand the positives.
And SpaceX is one of the biggest returns that this firm will see in its history.
And I also go back to the thing we were talking about earlier. We want everybody to become the best version of themselves. Now, again, we are strict on values and principles. And so we need to believe that when people behave, they're doing so with the best possible intentions. And they're doing so with a standard of excellence that we expect of all of our partners. If they are doing that, and if we happen to agree or disagree with the output, the agreement or the disagreement doesn't necessarily matter. It's the inputs that we tend to focus on.
I would say for the record that, Sean told me that he would not work anywhere else. And, he believes in the principles that you outlined. Also that, his belief is that his intentions were never to have a net harmful effect on the firm.
His intentions are pure.
His intentions are always pure. And that's another thing I was going to mention. But he also has great courage. There's conviction. There's people with conviction and they don't have courage. And yeah, you can talk all day long and then you don't sort of make the investment or you push
What does courage look like? What's the action that you're looking for the partners to take?
If you have a GP and you're not a GP and there's a vote of a 1 by a GP, but you still keep pushing forward, that is courage. You're willing to get fired for something that you believe is going to be a great investment. And that turns out to be one of the best investments that's in Sequoia history.
We have a list that we keep of all the different failure modes that we can run into on investments. And there are 40 or 50 of them, one of which is called wimpy sponsor. Wimpy sponsor is you say you love something, and then you get a no, and you just go away.
You just wilt.
You probably didn't love it if you got one no and you went away. If you actually love it, you're going to keep pushing and keep pushing and keep pushing and keep pushing and keep pushing, and that's what courage looks like.
I want to get to some of the investments you have made. So what we're going to do is take a quick break. We'll be right back with Sequoia partners Alfred Lin and Pat Grady, and we'll talk about the big one, which was Anthropic. This is Bloomberg Tech. We're back with Sequoia partners and co-stewards Alfred Lin and Pat Grady. I'd like to talk about the Anthropic investment. It's detailed in the Business Week article, but essentially it was something a bit new. It was an example of risk or franchise risk or risking the franchise. Where should we start with what happened? I mean, you were, along with Sonia, right, the sponsor on that opportunity.
So there have been multiple sponsors of this. We work as a team. There have been multiple sponsors on the company. Ravi had sponsored it for a period, one round. Sonia had sponsored it with him for another round. And then we kept passing. Part of it was because we wanted to sort of we were early investors in OpenAI, and we thought, well, we can't invest in both. And for a period of time, that was our mode until we checked with all of our founders, and they were using both companies. And
as in they were using the technologies of both.
Both
and they use them
OpenAI
for different things.
Exactly. And so obviously OpenAI started with the consumer app and finding information, and Anthropic had Cloud Code, and it was much more focused on coding. And so over time, we got greater and greater conviction. Our own engineering team was telling us how good the Cloud Code product was working.
Right.
So we gained more and more conviction over time that we should make an investment in Anthropic. On this $1 billion round, this last round that we made an investment, it came together because we had just been following the company, and 3 months before we had made an investment in the company.
That was January of this year.
Yes.
Yeah.
It was actually November, and then it closed in January.
Disclosed then, yeah.
And so we've been following the company. The revenue ramp continues to go up, and we decided that we're going to make a fairly large investment in this round.
A fairly large investment initially was $1 billion, but
that
the
was
idea...
the original recommendation by Sonia and I that we invest $1 billion, and we were like, where are we going to get the money? Well, we have plenty of places we can invest from.
Right.
And I was pleasantly surprised, first with a call from Sean, and then a call from Pat, and then in the room, we started with a number that I thought was like, interesting. Where are we going to get that number from?
Right.
And the number started at $5 billion.
And then you work backwards then?
Yes, to 2.5.
Pat, come in and explain your take on the events that transpired.
Well, I mean, the simple explanation for the investment is this is the tectonic shift of our lifetime. In a perfect world, we would have backed Anthropic many years ago. We didn't. And so the best thing we can do now is to come in at the most scale that we can muster. And so $5 billion was kind of a theoretical number mentioned to be provocative. We ended up at 2.5 because we can't really do $5 billion across all of our different funds. And so 2.5 is kind of the most we can do. And that's sort of how we ended up with that number.
Is it fair to go as far as to say, like, how much money can we deploy without putting the firm at risk?
Yeah, that was part of the conversation. 2.5 or 5 would be comfortable numbers as far as that goes. But one thing, we've never done SPVs. We're not in this SPV business where you speak for something.
I think we have enough time today to talk about SPVs.
Yeah, so we don't do that stuff. And so $2.5 billion was what we could do out of the core fund's committed capital.
Yeah. Let me ask you this, or give some background. Growth, early stage, since 2017, you've led the growth, you've co-led early stage, but you SaaS, consumer, but there's a lot of overlap, right? You have made significant growth stage investments and joined boards. You've made early stage investments, particularly in AI. Just talk a little bit about how the two of you see that progressing, forward looking.
I think it's very, very simple, which is like if you've been in this business a long period of time, you know what a good early stage investment looks like. You know what a good growth investment looks like. So Pat has been traditionally a growth investor. He made the early investment in Harvey. I've seen how early stage companies grow and advocated for growth investments in Airbnb and DoorDash when they grew up. And over time, I think if you've been in this business long enough, you'll make both early investments and growth investments. We have Constantine that championed Citadel Securities and Waymo. Yeah. We talked about Sean. We have David that has invested in a Neolab that's relatively early. We have Sonia, who's recently sort of flew with me to London to advocate for the investment in Ineffable. So our team is much more fluid, and we don't. Just going back to like most of our partners don't like being put in a box. Right. None of us want to be put in a box.
You also regard the partners. Sorry, Pat, to interrupt you. To say that these partners, if you stack them up against any venture firm in the world, they would be in the top 10 of the list of partners all time.
I genuinely believe that we have the best partners in the world. If Alfred and I got hit by a bus, we'd be fine. If whoever came next got hit by a bus, we'd still be fine.
Right.
But this idea of being able to go beyond early into growth into early, consumer into enterprise into consumer, I think one of the things you realize over time is that there are two core primitives in our business. It's people and markets. And if you develop a good understanding of what outlier potential looks like in a person, and if you develop a good understanding of where a market has a chance to go over time, those two ingredients kind of transcend the stage at which you happen to intersect that company. And so that's what we see out of the folks on our at Sequoia. As they progress, they can kind of go across stages.
I have to ask you both. Bloomberg reported this week that Sequoia was one of the firms approached by situational awareness as they tried in the reporting to offload some private stakes. We've seen what's happened in public markets. An opportunity to comment on that and how you see the situation.
We'd be delighted to comment on that. We were aware of that situation, and it has been reported that we were talking with them about the Anthropic stake. King Griffin showed up with what was a better solution for Leopold at that moment in time, and he went with the better solution. I think that our observation is that there is this game on the field over the last couple of years investing in the AI supply chain. Leopold was one of the first people to recognize that was the game on the field. And on balance, he played it pretty darn well. And so our suspicion is that he's going to be a fixture in Silicon Valley for a long time to come.
I wanted to get to the Valar case study. We've talked a bit about Sean.
Please
go ahead. Yeah.
On situational awareness, he did just wire $400 million to a company that we invested in. So.
We actually reported on the $400 million, but I haven't got a clue who the company is.
No comment on that. But he's not.
It's a good one.
He's not. He's going to be. He's really good. He's going to be around.
We just have, sadly, 2.5 minutes. I found what happened with Valar Atomics really interesting. Again, we're going over history, but would you just kind of explain how that happened? Sean was the sponsor. He made a really big proposal. Then what happened?
Well, we have a partner named Liam Corrigan who joined us just 6 months or so ago.
Yes,
and
you. Yeah.
Liam, physics undergrad at Harvard, happens to be an Olympic gold medalist, but he actually came from the nuclear industry before joining Sequoia. And so we have this person in Liam who understands the market to a great degree of detail.
Yes.
And then we have this partner in Sean, physics PhD, as Alfred mentioned, who deeply, deeply, deeply understands the technology. So the two of them together were working on this investment. And generally speaking, things that have multiple layers of technical risk remaining with a business model that is many years in the future, those are scary investments.
Right.
And so we're happy to take risk, but usually we do so with smaller check sizes. And so when the recommendation came out for a $300 million investment, some eyes popped out of some skulls.
Yeah.
And we said, boy, that seems like a lot of money for a company with this much risk in it. But Sean and Liam made the case. We decided to get on a plane. We went to...
You got on a plane. Alfred, you were in New York,
I was in
right?
New York. I was in a Citadel Securities board meeting.
Yeah, a few of us got on a plane. We went to visit them. We spent the whole day with them. We got to know Isaiah and his team. Isaiah is truly a one-of-one, force of nature, exceptional founder who we're now delighted to be in business with. I think we started to appreciate exactly how many of the different pieces they've put together, how novel their approach is, and how well they're executing. And at the end of the day, like Sean and Liam, we think they are right, and we rode with their conviction.
We have literally 30 seconds, and I'm sorry to do this to you, but let's end it with your white swan memo. What would the title be if you did a white swan?
I just think that there is a lot of negativity around AI, and it's really just misplaced.
Yes.
I think we have a tectonic shift in AI. We have a tectonic shift in hardware, tectonic shift in semis. We have a tectonic shift in industrialization of America. The future is very bright. And if I had to write a memo today, it would be a white swan memo, not a black swan memo.
Sequoia partners, Alfred Lin, Pat Grady, thank you both very much.
Thank
the
you.
Extended conversation. That's it for this edition of Bloomberg Tech. One last look at shares of Google. Alphabet drew out about $115 billion of orders for a $25 billion debt offering. There's also the background of those departures we covered 24 hours ago. Recap all of that on the podcast. You know where to find it. Beautiful day here in San Francisco. This is Bloomberg Tech.